Let's talk about auditing the inventory cycle. What are some proper segregation of duties and internal controls? First off, we're dealing with segregation of duties. We want to do our best to make sure that there's no fraud or error or anything like that. We want to separate out the authorization, custody, and record keeping. How would we test segregation of duties related to inventory? Well, we could just ask questions. Hey, do you know of anyone who has both custody and authorization functions? Like, just asking questions is not a bad thing. Now, you inquire, but then you have to follow up and corroborate that. So there's confusion where maybe, because you can't take inquiries as audit evidence in and of themselves, but you can use inquiries to then poke and prod around. You get ideas. Someone says, "Oh yeah, I think Joe over there actually has authorization and record keeping functions." So that would be a great way to test. And then you obviously just observe, look around, and see in terms of any of that, is anything being breached? Now, while we have professional skepticism, we talk a lot about tests which examine areas that can be overstated and susceptible to fraud. We also need to see if counts are understated, likely due to error. I'm going to mention this, and I do mention this a lot. It's fraud and error. Because in relation to our financial statements, just a reiteration, we want to make sure that they are accurate. Now, they could be inaccurate because of fraud, because of overstating assets or revenues, but they could also be inaccurate because, let's say, because of error, revenues and assets are low. Now, it's your job to help find both of those. Again, just to reiterate, management could be completely ethical, and maybe you trust them completely, right? There's just, I mean, this is not reality, but there's not a fringe of doubt that there is any fraud. But the thing is, think about error. If there's error and the revenue is lower, that's not accurate. And if it's material, that's a material mistake. So just reiterating that point, like to bring in these important concepts. We could also examine the access to inventory systems, see who has that. That's custody. I mean, also even past authorization, custody, and record keeping, you want to see who has access to the inventory systems, and then maybe go in and investigate them further. You could also analyze inventory transaction data for any unusual dispositions of inventory, transfers of inventory, looking for anything strange. You could evaluate the roles and responsibilities of personnel involved in inventory handling. Again, kind of similar to inquiry, but this is where you're actually going in. You could observe, but then you actually evaluate. Take a step back, think about it. It makes sense. You could test the accuracy of the physical counts of inventory. You could investigate the completeness of documentation for inventory transfers. Is inventory being transferred to other warehouses with which it's being stolen at that warehouse? Making sure that the documentation's there and it's being properly authorized and properly checked, and there's not a chance that it's being stolen in transit. There's a lot when it comes to physical inventory, a lot of risks. I'm not in defense of massive major companies, but for example, Walmart is just, they are always dealing with fraud, theft. That is one massive component of their business they have to worry about, whereas Google, software-based companies, don't have to worry about that. Now, our job is not to defend multi-billion-dollar companies. Hey, I'm not trying to say that, but our job here is to make sure that the financial statements are properly stated. We want to examine the approval process for purchasing and receiving inventory, making sure that nothing's going through without the proper approval, confirming that inventory is stored in an appropriate location, and lastly, verifying that inventory adjustments are properly approved and documented. All these phenomenal checks for segregation of duties. Let's talk about the existence assertion. Now, this is taken, we see this exact comparison and wording from our other cycle lesson. Going over this, it's obviously, I want you to memorize it. I want you to have this down. And just to reiterate also, one procedure can assist with multiple assertions. So we're going to see separate slides on existence, completeness, occurrence, all these. Now you may see that one procedure could work for multiple of these assertions, and that's okay, right? And similarly, it works the opposite. You could have one assertion that is satisfied by multiple procedures, and just it's very amorphous. We've got all of these possibilities, so it's your job to, yes, it's a combination of memorization but understanding. You want to memorize these procedures as well as just understand them at their core. Now, existence, this is the assertion that the entity actually has the asset or liability. Completeness is that all transactions and accounts that should be included are actually included. And occurrence is the assertion that transactions and events have occurred in the proper period and have been properly recorded. Perfect. Looks good there. Now, how are we going to verify the existence of inventory? We could review and test control procedures over the physical inventory count. Now, this is a test of control, but it would also help verify the existence of inventory. Yeah, you can do substantive procedures to verify the existence, but also doing tests of controls, which would then tell you that maybe you can do less substantive procedures, so you tie in audit risk there. This would be incredibly helpful. Now we could also examine inventory records and any related documents, making sure that this inventory actually exists, getting that proof existence a little more straightforward. Just think about it. How would you prove that this actually exists? You could also observe the physical count process. Now, the auditor does not actually count the inventory. This is something that may differ in real life, and I say this a few times throughout different lessons. Now, maybe you as a staff accountant, staff auditor have gone to actually count the client's inventory. However, per the rules, per the AICPA, and per what we should be learning here on the exam, the auditor does not actually count the inventory. That's the client's job. The auditor just observes the client counting. So you just stand there and watch them count and make sure they're doing a good job of it. Now, it might seem like, oh, you're just being lazy and not helping out, but that's the rule. That's what we need to follow. And you could see questions on that. You could also see tricks. You could see the auditor was counting inventory, and right away, that's a concern. So whatever the question is, there's a little bit of a trick there. You could also inspect and test items of inventory. This could really involve anything. It's pretty broad. Investigate unusual or unexpected differences. After all of these procedures, you can obviously investigate any differences. And then performing surprise counts of inventory. You show up to the warehouse and say, hey, I need you all to count the inventory for me. It's unexpected. So any test that is unexpected and you just pop up, that's going to be a more effective test because no one has the ability to hide any fraud that they were doing in the moment. Lastly here, existence is testing if all inventory listed in the financial statement accounts actually exists and is legally in the company's possession. Perfect. Making sure you got that down. We're going to dive through, have a good time. Continuing on, make sure you're stretching, you're smiling. Smile. If you're not having a good time in life, what is the point? Continuing on here, we've got completeness. Now, these are the same sentences we saw before. I'm not going to read them again. How would we verify completeness? Well, this is that the transactions and accounts that should be included are actually included. We are going to perform cutoff procedures for shipping and receiving. We're going to tie that in a little bit there, making sure the listing is complete, that 1/1 year 1 to 12/31 year 1 is complete. It properly includes all inventory that should be included. This is going to tie into FOB shipping point destination. We got also our goods on consignment. We're going to examine the inventory count documents. We're going to check if receiving reports are pre-numbered and periodically reconciled to determine if all goods received have been recorded as inventory. Now, we've got a lot of documents. We obviously saw a slide on the different types of documentation before. We'll talk about those much more as we go on as well. But we want to make sure that, we generate a receiving report and say, this is 10 units of inventory. This is report 101. Then we received 5 pieces of a different inventory. That's report 102. And reconciling those to everything within the accounting system to make sure that all the checks are there in place. We want to perform physical inventory count, as we mentioned, right? We've got procedures that can help for multiple assertions. We can reconcile the inventory records to the general ledger. As we said, this is completeness, tracing. This would be tracing, making sure you get the source documents, tying it to the accounting records. You could compare the inventory records to purchase orders and sales invoices. So making sure that, we did purchase it. We purchased 10 units. We recorded 10 units, and then, we sold 10 units, making sure that we can actually understand the life cycle of that inventory. Lastly, investigating any discrepancies between the inventory and the actual count. Obviously, for all of these assertions, we're going to have a point where it's going to talk about, hey, if there's any issues here, just make sure you investigate that a little further. Now, lastly, completeness is testing if all inventory on hand is reflected in the ending inventory. Very good, very good. We are having a good time. We're powering on. Get some snacks, have some popcorn. I don't know. Popcorn's on my mind lately, I guess. I'll try to get some later. Tying into valuation, allocation, and accuracy. Make sure you have these memorized. What's the difference here? Because that could save you a lot of points. Accuracy, this is the correctness, any errors, any incorrect dollar amount. Valuation, the dollar amount assigned to the asset, liability, or equity account. And allocation refers to the movement of amounts from one account to another. Right? We think about the general ledger. If you haven't worked in accounting yet and you haven't seen a general ledger, it might be a concept that's hard to comprehend, and that's why I've included it in various lessons. But generally, it's like, all right, you got 3 bank accounts. You got one savings account, one payroll account, one normal checking account, and you could have account 101, 1002, and making sure that these are properly allocated, that the dollar amounts now, like this account 1001 could be a Chase account. This could be a Bank of America, and then the other one could be some other bank, right? Making sure that you're not commingling these, or if you are, there's a reason for it, and just making sure that it's properly allocated. So that's just our example here. Similarly, we've got different accounts for our inventory. This could be unit inventory type C, B, and then A, right? Making sure that we're not commingling or intertwining them. Now, how would we test these Assertions, we could make inquiries of production and sales personnel concerning possible obsolete or slow moving inventory. That's a classic one. Ties into this analyzing inventory turnover rates. If we see our inventory turnover ratio is looking pretty bad, we're not actually turning over inventory, meaning it's just sitting around and not being sold. That could be an indication that we've got inventory that's not valuable and it may need to be written down. We could test the company's computation of inventory costs by ensuring that the company's method for calculating costs is accurate and consistent. That's obviously great. Making sure that we do a little test of controls where we're going in and seeing, okay, can we properly compute and how do they actually get the dollar amount of their inventory? We could review the physical characteristics of the inventory on hand, right? If they say they have iPhone 12s and then we go in and see that they're all iPhone 5s. Now, you may not be an iPhone expert, but maybe you just Google what it looks like and you see, oh, well, they're lying. They actually have a bunch of iPhone 4s, but they were valuing them and saying they were iPhone 12s. We could compare inventory prices to vendor quotations. We could examine price trends for similar products and investigate the inventory valuation methods used, really just making sure that the dollar amounts are correct. If you're selling the same good that someone else is that another company's selling, you as the auditor can make sure your client is properly valuing it, right? If we're talking about couches, you are auditing a furniture manufacturer, and it's just the same couch. Multiple companies are selling the same type of couch. If they're valuing it at double the cost, well, why? Is it made with better materials? Maybe it is, but if not, you want to make sure it's accurately reflected. Rights and obligations. Do you have the rights to your inventory and did you actually pawn off the rights to it somewhere? Rights and obligations concerned with the assets and liabilities on the balance sheet. Rights means that the assets are not pledged as collateral. They're fully owned, not subject to a lien. No one else has the rights to it. No one could take them from you in a lawsuit. If any assets are not fully legally owned, this should be disclosed and the assets may have to be reclassified. Obligations means that all liabilities owed by the entity are properly accounted for and that any potential liabilities are identified and accounted for in a timely manner. Are we accidentally or purposefully not including a credit card balance we owe or any AP, making sure that those are all stated? How would we test the rights and obligations? Well, you would examine the records of purchase orders, receiving documents and vendor invoices, verifying the ownership of inventory items, making sure that it's properly stated that it's owned. You could go through and reach out to legal counsel, just some other things, ask the board of directors. You could examine debt covenants. If you look at all their debt agreements, the debt agreements might say, oh, well, guess what? In order to take out the money you borrowed from us, you have to pledge your inventory for us. Now, that could be a concern here, something to consider, something to watch out for. Presentation and classification. Now, understandability of presentation relates to ensuring that information included in the statements has been appropriately presented and is clearly understandable. As we mentioned before, all the dollar amounts could be great, everything else could be great. There could be no completeness, existence concerns. But if the financial statements are misleading because you can't properly understand them, well, that's not going to benefit those individuals' financial statement purposes. Classification assertion states that the information provided is presented accurately in the proper categories, such as short term versus long term. Want to make sure that we are doing that. Now, if you are flipping houses, you probably are not going to classify your inventory, which is your houses under construction, as short term inventory. Because guess what? It's probably going to take you a few years to build those houses up and then flip them. So that's just another example. Give many examples throughout time here. How would we test the presentation and classification of inventory? Well, we want to ensure that the inventory is properly identified and segregated. You're going to make sure that chairs are not accidentally classified as tables, etc. You want to check that inventory quantities and locations are accurately stated. You want to make sure that if we say, maybe the dollar amount of inventory is correct and the amount of inventory we list is correct, but if we have two warehouses and in reality it's 50-50, we have the inventory split, but the financial statements say that all the inventory is in this warehouse. Now, you may not think that's a big deal, and maybe it's not a big deal, but that's just part of what our checks are here. We can't say that it's all in this warehouse. We have to accurately state that it's split between the two warehouses. We want to confirm that the inventory is physically present. Obviously, this ties into existence, but also ties into presentation and disclosure. And then examining that obsolete and slow moving inventory is removed from the system. Guess what? That would not be classified as normal inventory. That would be possibly obsolete inventory having to be written down. This is just my take. This is not, some of these departments I'll point out are more important to know. This is not for the ACPA. This is just generally to get an understanding of the inventory cycle, who's involved, understanding it as a whole. Like, right, what's our goal is to understand the inventory cycle. Pretend you're working as an employee in the inventory cycle so you can understand what's going on there. Now, the purchasing department, this is responsible for purchasing merchandise from suppliers and negotiating the best possible prices. That's also going to be something. What are kickbacks? Well, if I am in the purchasing department and I am buying inventory, let's say we buy planks of wood to build furniture. If I buy planks of wood from my friend's company at a higher price, and then my friend gives me a little bit of money from each sale, well, that's called a kickback, and that is illegal. That's not allowed. That's a problem. That's fraud. That's something that the auditor would help to look for, is to make sure that, well, and the person who works in the purchasing department has a fiduciary duty to save the company they're working for as much money. And that is going against the company's best interest, is because you're pocketing money for yourself. That is definitely a concern there, something to look out for. The receiving department. So we purchase inventory that we maybe just resell it immediately, or we rework it, or if we purchase planks of wood, we build chairs out of them and then we sell them. But the receiving department, this is going to receive the planks of wood or the finished chairs that we're going to immediately sell somewhere else, checking their quality and accuracy, making sure that the products match the purchase order. Critically important here, because guess what? The purchasing department purchased 10 chairs. You want to make sure, did we get 9? Did we get 11? Okay, maybe if we got 11, we're not going to tell anyone, but no, that would not be ethical. I'm telling you, don't do anything unethical. But this would be the receiving department's job to make sure that everything ties out. The inventory control department, this is responsible for tracking the company's inventory levels and making sure that the company has enough inventory to meet customer demand. May not always be up to them. Maybe macroeconomic factors, there's not enough inventory to go around, but hey, they're going to do their job best they can. The warehousing department, this is responsible for storing the inventory in a safe and secure manner, as well as ensuring that it is organized and easily accessible. You've got your shipping department. These individuals are going to ship inventory to customers in a timely and efficient manner. And our all too important, and of course, we're all accountants here, so this is, they're the best. These are the best people. These individuals are going to tie into every cycle because they are responsible for keeping accurate records of, in this case, inventory, but any account that we're going to see with any of these cycles. In this case, inventory levels, their costs, and their sales.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.